Larry, thank you very much for joining us today. You spend a great deal of your time on the road traveling, meeting with investors. Where are you now?
We're in Panama this week. It's nice to be back, and the European trip was fun, but it was a little too long this time.
I want to ask you about that. But before I do that, you have written extensively on previous cycles. You lived through the tech bubble of 2000 and the great financial crisis of 08, 09. And I want to tap into your knowledge of these events and see if you see any similarities between what we're living through right now and these previous events. And when we look at the tech bubble, the one thing that really stood out to me was valuations. And I kind of see that right now. But at that time, the poster child for the whole tech bubble was Cisco. Its market cap at the peak was $550 billion. It was trading anywhere from 30 to 40 times revenues. Now the poster child for this AI bubble is NVIDIA. It's trading at or around $3 trillion. 2 trillion of which came in this year alone, which is quite hard to believe. And it's also trading around 40 times revenues. But when you see a name like NVIDIA and many other names in this current bubble, does it remind you of the tech bubble of the early 2000s?
Well, you know what, Jim, what I've learned is, you can get everything in life that you want if you just help enough other people get what they want. And so what I did was, with the first book, we did 140 speeches in 16 countries and met a lot of talented investors over the last decade. And then we created this Bloomberg chat where we talk to hedge funds, mutual funds, pension funds during the day. It's like a live ideas dinner. And yeah, the takeaways that I'm getting by triangulating information and kind of by running, this whole thing through a lens of really experienced investors, it's very similar in the sense that everybody wants to be in one part of the trade, but what people are really missing is that there's multiple legs of this trade of artificial intelligence. Like, it's an industrial revolution. And so what happens is, early on, what we saw in 2000 is, in the same thing I think we're seeing here, is you go up on euphoria and then down on impatience. In other words, if return on invested capital of all this capex, maybe 3 or 4 FANG stocks are doing close to 200 billion of capex now. A lot of that's going to NVIDIA. So it's a very concentrated group of everybody's invested in the same kind of thing. Whereas we think there's going to be much, much more spectacular opportunities on the infrastructure to get to that green meadow, or not just to that green meadow, but all the power that's going to be needed to really get to that NVIDIA valuation, or the evaluation of, say, Microsoft, to justify this. To get there, you're going to need a whole new power infrastructure, and everybody's focused on kind of the first trade instead of the 10-year trade.
And so when you see a name like NVIDIA, though, that's trading at or around $3 trillion in market cap, are you concerned about that?
Well, the biggest thing is, I've never seen the street right on any major research theme. In other words, when Wall Street when all the analysts are saying, buy, and they've all taken their price targets up. So if you just count the analysts, there's close to 40 analysts that cover NVIDIA. And if you count how many times they've raised their price targets, it's quite disgusting. It's quite pathetic. I mean, you're talking about people like a year ago that didn't like the stock, or a year and a quarter ago that had low price targets, and all they're doing is it's like groupthink. I mean, if you're a Wall Street analyst and you live in, say, Westchester, maybe you're on your second marriage, all these people do is just hide out in groups. Nobody's really doing very, very much original thinking. And so it's very dangerous to invest in something that the entire street has a buy on. There's no sells, and then they've not just that, they've taken the price target up together. Each analyst has raised the price target up 5 times. So it's just kind of the gang that can't shoot straight, and most times they're wrong.
They're like lemmings.
Yeah, it's safe to hide out in herds, especially after a divorce. And that's one of the lines in our book, How to Listen When Markets Speak, is that that groupthink is very toxic in some ways, but it's also very captivating. That's where the analysts want to hide out in groups.
And we saw a lot of that in the late 1990s and the early 2000s. But When you look at a name like NVIDIA and the rest of the Meg 7, are you concerned about these valuations? And I guess I'm also comparing this to the year 2000 when the NASDAQ did top out in March of 2000. In the ensuing 2 years, it lost 78% of its value. Do you see that happening now?
We see in the book, When Markets Speak, we talk about more about a great rotation. So if you think of the NASDAQ 100, it's $23 trillion. And if you think of the energy stocks, today it's 3 trillion. So picture the NASDAQ 100. So all the NASDAQ 100 stocks, $23 trillion in value, and all the energy stocks are about 3 trillion, a little bit less than $3 trillion in value. Well, 10 years ago today, the NASDAQ 100 was about $4 trillion, and the energy sector was a little bit more than 3. So you've got the NASDAQ 100 that's gone up by about 20 trillion, and the energy sector that's going to be needed for the next 20 years to support a lot of things, especially on the natural gas side. That sector is roughly, not the same size. You've had a big comeback the last couple of years, but it's roughly the same size as it was in 2014. So yeah, that's where we're looking in terms of valuations.
I'm sorry, you said the value of all the energy stocks in the S&P 500 is how much?
Right now, it's a little bit less than, so call it 3 trillion to 2.8. And so it's gone from essentially, 3.5 trillion 10 years ago to 2.8. It's small, a little bit smaller. And the NASDAQ 100 has gone from $4 trillion to 23 trillion. And so it's just it's what we talk about in the book is like when you've gone through a long period of very certain deflation, people hide out in growth stocks. And but when inflation becomes a little bit more certain in a multipolar world, and we see this week, we are definitely a multipolar world with a lot of global conflicts, a lot of stimulus packages from China, and a lot of things that could potentially create an inflation bounce. Oil prices in a multipolar world and a stimulus plan from China, that could get us a big inflation bounce. If we get a big inflation bounce, then you're going to see $5, $6, $7 trillion come out of growth stocks and go back toward value, back toward hard assets.
So I want to ask you about the great financial crisis now, because you experienced this firsthand. You were right on the front lines. You were working at Lehman Brothers, and you lost your job during this time period. And you wrote a book, The Inside Story of the Collapse of Lehman Brothers. Tell us about that time and if there's any similarities between then and what we're seeing right now.
Well, the biggest thing we talk about in our first book is, the hubris of the management teams of the big banks. And hubris is one of the things that I think investors should really watch. Management teams across decades, whenever management teams get really that hubris mentality, and signing Braziers, the CEO of NVIDIA, that's a hubris moment. Like, why would you even do that? I mean, you think about your classic, executives of major companies that we, have to look up to, that's just classic hubris. And yeah, that's the big thing that I see is today versus say 2000 is just, not very much respect for risk management, where there's a concentration of investors in one place. And then it's the same thing like with the financial crisis, where everybody was long securitized mortgages, a lot of these crazy structured products that nobody really understood, and people really didn't understand the leverage. And same thing today. There's a lot more leverage under the surface with private equity and with all the structured products on the public and private. There's a lot more leverage in the system than anybody realizes. It's just this time is not on the bank balance sheets. It's more spread across private equity and the asset management industry.
In the summer of 2007, there was a collapse of a couple of hedge funds that Bear Stearns was running. They were the high-grade structured credit funds, both focused on subprime. And I remember very well when these two funds collapsed or went bankrupt, nobody thought much of it. And then as the year went on and as we entered 2008, more trouble started coming to the surface. Do you see anything like that happening right now? Is there anything out there right now where you're thinking, that should be a point of concern?
Well, just think about Powell, what he's done, right? He sees something because the Congressional Budget Office in January told us that the deficit this year would be 1.6 trillion. 1.6 trillion. Powell talks to these people. He knows that we're actually coming in now at 2 trillion. So we've gone from 1.6 to 2. So they spent an extra $400 billion in Washington. Now that's part of that's election year rigging. It's not rigging, but any Republican or Democrat would try to pull that off, right? You want to give yourself the best shot. So Powell knows that that kind of fiscal overdose is going on. He also knows that that the Atlanta Fed in recent months has said that GDP's gone from say almost 2 to 3%, and he's still cutting 50 basis points, right? So either he sees something or he's trying to influence the election. It's one of the two. I mean, you just can't cut rates, and then on top of that, the bank, the PBOC in China, they just came up with the largest stimulus plan since the great financial crisis. So you have an extra 400 billion of fiscal spending. You have 50 basis points of rate cuts coming from Powell and promised many more, and now you have $1 trillion plan coming from China. So this is just a real potential cocktail recipe of like unintended consequences. And what does Powell see? He probably is looking at the regional banks. Why is he kind of let's play devil's advocate. Why is he cutting 50 basis points and with all of this fiscal spending and all of this kind of strong? He claims the economy is so strong every Fed meeting, and it's probably that what he saw with the regional banks, and you had Signature Bank, Silicon Valley Bank, New York Community Bank, all these banks went down because interest rates went up, bond prices went down, and on those bank balance sheets, if rates stay here, Jim, that extra $1 trillion of commercial real estate loans are going to reset from 2, to maybe 5, 6, 7, 8%, and that's going to blow up some banks. He knows that. Then the interest on the budget, right now, the average weighted coupon on the U.S. debt is 2.6%. And so if he goes higher for longer and he keeps rates here, that's going to reset up to 3, 4, 5%. So interest will go from right now 1 to 1.1 trillion a year. If he keeps rates up here, you go to 1.5, 1.6, 1.7 trillion a year over the next year. So yeah, he's being forced by political and by political pressure and interest rates to cut rates when he probably shouldn't, and that's going to create an incredible move of what we call in the book When Markets Speak, a great migration of capital. Everybody's going to have to own a different type of portfolio in the next decade.
So if I were to ask you what a potential black swan event could be, because like I was alluding to earlier, you never know what it is until many years after the fact, but do you think that's what it could be? Interest rates are too high and therefore it's still hurting a lot of regional banks. Maybe it's going to be the collapse of commercial real estate within bank portfolios just because of this hybrid working policy that so many people are doing or working from home.
Yeah, if they don't cut rates 100 basis points, you're going to have look at the way U.S. Bancorp traded Zions. You're going to have the U.S. Bancorp's the 5th largest bank in America. And so these banks, like when the last time we had that interest rate spike, these banks were in some serious pain and, large drawdowns relative to the market. And so there's a crisis brewing there. And then there's also a crisis brewing on the private equity side. There's a lot of really ugly marks on the private equity books. And if you look, one of the things we do, like I said, we host that conversation with institutional investors. Most of our clients are institutions. The Bear Traps report also reproduces that conversation for a wider audience, for the retail and family offices. But that's the one point they make to us is the marks across the private equity space because rates have gone up over the last couple of years. A lot of these things there's what they call mark to model, mark to market. So it goes mark to market, mark to model, and then mark to myth, right? And so that's what I think was one of Buffett's lines, and that was one of the lines in my first book. Is the mark to market? You're supposed to mark the loans, or the private equity loans to market. And you can mark it to the model, and then in the end, you end up marking it to the myth, and that's what creates the seeds for a financial crisis.
So Jamie Dimon of JP Morgan has expressed concern about the current economy, and he's also expressing concern about inflation. And he thinks inflation might heat up again, just given this expansionary policies in the US and now also with China. Do you think there's a threat of inflation heating up again in 2025?
Oh, I think it's so now with this union strike. We've got the ports across the United States, and it's one of the largest strikes in the history of America, and it just went off last night. And that's the thing: inflation gets under the seat cushions. Once it gets in there, it's very difficult. It takes decades to get rid of it, because if you're a union member and you're, whatever they say on CNBC, whatever the government tells you, you go home and you really can't provide that well for your family the way you could 3 or 4 years ago, because it's not how much inflation came down this year. It's you're feeling the 30% of inflation over the last 3 years, 3-4 years. And so that is really really incentivizing union members to not settle. And keep in mind, they just rejected a 50%, Jim, 50% pay raise. They rejected it. They want 65, Jim, 65. That's extremely inflationary. And then Trump's tariffs or Kamala's tariffs, protectionism, extremely inflationary. And then we have this China $1 trillion stimulus package that just is going to basically create a massive pop in commodity prices over the next 6 to 9 months. And then you have the 50 basis points of rate cuts from the Fed. And then on top of all that, you have you got a $2 trillion deficit this year in Washington, an extra $400 billion of spending. It's an inflation bounce is, I think, nearly certain, and it is going to be a big shock, and that's what's going to create this great migration of capital.
And so let's think about that for a minute, because you just said how important it is for the Fed to cut rates because of these looming interest payments that are going to go from $1 trillion to 1.3, 1.4 trillion or higher. But then at the same time, there's this threat of inflation increasing. So if we're looking out to, say, the first half of 2025, do you think there's a threat that the Fed is going to have to lift interest rates again? Like, how do they balance that?
Yeah, so they'll use their vocal cords as much as they can. And if you think of the 80s and 90s, those central banks all definitely went back and forth more. Whereas in the last 20 years, we go through these long cutting cycles and these hiking cycles. Whereas in the 80s and 90s, when it was much more inflationary world, multipolar, there was a lot of stops and starts, right? And that's what we're heading back to. But at the end of the day, when you have 35 trillion of debt, the only way to get out of that, you could have a debt jubilee. We could look back centuries back to the Bible. There's references to the debt jubilee, where it's kind of like a social reset. But that's not going to work today. So the only way out is what's called financial repression. And that's where they're going to have to keep interest rates below the rate of inflation. So keep interest rates below the rate of inflation. So they'll actually keep the Fed funds rate most likely below the rate of inflation. And that creates a weaker dollar over time. And that's what gets you a much more sustained inflation regime. But that's how you get out of that debt. That's how you grow your way out. You inflate your way out of that $35 trillion debt hole. That's what they want. They won't tell us that, Jim. They won't tell us because they'll scare everybody. But that's what they want behind the scenes in Washington.
Very interesting. Okay, so you made mention earlier that in this environment that you see transpiring, we're going to have to adopt a new investment strategy. Maybe you can tell us more about that and what you're suggesting. Well,
so our book, what we talk about is, so from 1968 to 1981, we had a multipolar world. We had the Vietnam, coming out of the Vietnam War. Wars are very inflationary. And we had a much more insane, sustained inflation world, a much more multipolar world, global conflicts. The supply chains around the world were not smooth at all. And we had protectionism, so we had a lot of these things that created this sustained inflation regime world. And so from 1968 to 81, the market really didn't go that really didn't go anywhere. But by the end of it, energy, industrials, so oil and gas, industrials, and materials, hard assets, those groups were 49% of the S&P 500, 49% of the S&P 500. Within the last year and a half, those three groups, so energy, industrials, and materials, so that's like all your metals, all your uranium, those groups in the last year and a half were just 12% of the S&P. So we've gone from 49% of the S&P to 12. We're not going back to 49, but are we going from 12 to 30 or 12 to 25? Yeah. And so that means that your BHPs are going to be, or your Chevrons or your Exxon, they're going to be back up in those top 10, top 20, top 30 companies again. Maybe your Newmonts or maybe your Barracks, maybe an Alcoa. You think about Alcoa making, one of the largest aluminum producers in the world. Aluminum's going to be needed for that power grid in the United States and all of these data centers to support artificial intelligence. So you want to have a whole new portfolio. Your Rio Tintos, your companies that own hard assets, companies that actually own assets that are in the ground that are going to protect you from inflation.
So let's talk about some of those assets. Let's talk about gold, for example. Okay. So it's having a pretty good year. It's up 25% on the year, give or take. Where do you see it going in this inflationary environment?
Well, gold's got 3,000 written all over it, but to me, it's almost insulting at this point. Today UBS up their target, Goldman up their target. Whenever the street really starts to like gold, you want to start being a little bit more careful. So what we've been doing is the relationship between gold and say palladium, the PALL ETF, PALL. That's something where that's 2 standard deviations outside the norm, that gold palladium ratio. So if you have some gold, you will basically want to sell 20% of your gold and buy a basket of palladium, platinum, silver, some of the other metals, rare earths. You've got the rare REMX, which is your rare earths ETF. And so you want to own a basket of these other metals that for the next 20 years, you're going to need them for the green metal. You're going to need them for the energy transition. So it's actually a much more intellectually smart place to be. When these solar panels are becoming so much more advanced, they can rotate. They require a lot more silver, right? Palladium is used in hybrid cars, and potentially platinum and palladium is going to be used in green hydrogen. So these are really sexy metals that are the cheapest to gold we've ever seen, and it just makes sense at this point in the cycle to rotate into at least 15-20% of your gold should be in a whole other basket of other metals.
You didn't mention uranium.
Well, yeah, I thought you'd want to get into that. I should look at that as a metal, but yeah, it's uranium is a core one of our holdings since 2020. It's a high beta sector, so you got to be careful. Like your URNM ETF is very, very volatile relative to the market. So when someone says high beta, a high beta sector moves like this, and the S&P might move like this, right? So all high beta means is that if you get into it as a younger person or as a person that can't handle that, you want to get in with a 1/3, and then you want to be there for that volatility. If you want to buy a new sport coat and it's 20% off at the store at year end after Christmas, you want to do that, right? But people in markets, they always want to chase the higher prices, and they want to kind of cut bait when things get a little bit cheaper.
So I would argue with you on one point. You said you're concerned about gold because Goldman Sachs, Morgan Stanley, and other U.S. brokers are getting involved in it. But when you look at the equities, they're still not trading at 2,500 or 2,600
Oh yeah,
gold. And Newmont, for
yeah.
example, the world's largest gold producer, is trading slightly above. I think it might be up 30% on the year. Barrick, it's only up 10% on the year. So it's still not being reflected in equities.
Yes, no, and I should have said that. So what we look at is the gold to GDX ratio, or the GDX to the GDXJ. The GDXJ has been breaking out versus the GDX. Yeah, so you want to be long these juniors. You want to be long because the bottom line is, if gold stays anywhere near here for an extended period of time, the profits of these companies is really going to be attractive because their cost of production is relative to previous, relative to other cycles. The amount of debt on the balance sheet, the balance sheets are a lot stronger. And so, yeah, I completely agree. I'd love to be. We're long the GDXJ. We would actually. I should have made myself more clear. I would sell 20% of my gold and buy a basket of the junior miners, GDXJ, SILJ, uranium, and then your platinum, your palladium, and silver.
So you mentioned you could see gold going to $3,000. That's like a chip shot. You must have a higher target than that.
Well, I think, yeah, if we really get this this inflation surprise, and then right now they're running that $3 trillion deficit in Washington, and if the economy slows down with this kind of deficit, then all of a sudden tax receipts come down, then you really start to move to the hard asset regime, and that's where you could get gold at 3,500. But to your point, your other point is the most important point. If, like, you think about the S&P, at one point in like 1980 or 81, you had at least 2 or 3 gold companies that were in the top, I think, 20 stocks, right? 20, maybe 25. And so that's really the sexy trade, where right now I don't think there's not one gold company. Newmont's probably the largest market cap, but I don't think it's in the top 20 S&P stocks. I mean, you could have 2, 3, or 4 of them in the top 20 or 25 in a real 1981 type stagflationary world.
And do you see stagflation happening?
Oh, I think it's this latest. This is just like I said, it's a deadly cocktail. We talk about this in the book, When Markets Speak, where politics drives things like this. The Fed was not expecting, they just cut 50. They weren't expecting this $1 trillion stimulus out of China. They weren't expecting this big strike across, all the ports. And so, yeah, it's going to be this really, I think it's very certain that we're going to have, relatively high, like a year or two from now, higher unemployment. A year from today, we'll have higher unemployment with slower growth. And so right now we have really low unemployment with decent growth. And so once you go into that higher unemployment with slower growth, and interest, and your interest as a percentage of tax receipts right now are trending toward 25%. Interest on the debt as a percentage of tax receipts. AAA rated countries shouldn't be anywhere near that. They should be like less than 10. So think of interest relative to your tax receipts from taxing, your corporate taxes and your individual income taxes. And so, yeah, that's all pointing toward a real hard asset regime, stagflationary world.
So you're bullish on gold, silver, uranium, many other metals. I got to ask you about Bitcoin, quite often referred to as digital gold. What are your thoughts on that?
Well, Bitcoin's great. It's just the Bitcoin crowd is full of evangelists that suck young people, investors in at the highs, and then on the lows, they're nowhere to be found, crickets. And it's pretty pathetic. It's pretty sad. And unfortunately, that's what creates, like, they have a really good, like, the thesis of Bitcoin is sound, the scarcity, the fiat currency regime, everything we talk about in When Markets Speak, right? That Bitcoin thesis is sound, But what happens is they don't really tell people that Bitcoin is actually your liquidity victim, right? Because it's a $1.5 trillion market, of which there's probably 50 or so, 40 or so people that own 40% of the Bitcoin. A lot of that, some of that Bitcoin's lost. So your actual Bitcoin market of available to trade Bitcoin is relatively small. And so that's why on August 5th, when one large player needs to get out, August 5th, we had every time the VIX, Jim, every time the VIX, look at the returns on Bitcoin when the VIX has gone between 20 and 40. Every time it's a pretty nasty drawdown, because all it takes is one large family that's been in Bitcoin for years, a billionaire. He just wants to take some off the table. Maybe he's got a margin call on something else. And next thing you know, some poor teenager gets wiped out on his cell phone with his Bitcoin account. It's pretty disgusting. People have to understand, nobody gets this. Like, gold's a $16 trillion market. It's almost 17 now, 16, 17. So your largest drawdown in gold the last 10 years is 22%. That's a store of value, right? It's so deep that if someone needs to sell it, it doesn't get disrupted very easily. Silver is a $1.5 trillion market. So gold 16 and a half, silver 1.5. Platinum and palladium are smaller. You're talking like combined maybe 250, $300 billion. So you got to be careful with those smaller markets because they just offer tremendous volatility. But if you look at palladium, for example, you've had two moves in the last 30 years of, I think, 1,800% higher and 1,500% higher. Those are like two bull markets. So 850%, 1,500%. But once again, platinum and palladium don't offer a lot of liquidity. Bitcoin, over the years, Bitcoin is going to grow. Each year, it's going to get better in terms of liquidity. The investor base is going to broaden out from those top, maybe 40 or 50 families that control 60% of the Bitcoin. And once that happens, once that broadening happens, it's going to be much safer investment. But at the end of the day, if you buy Bitcoin today, you better be prepared to buy it down 50%. So go in with 1/3 or 1/4. But if it goes down 50%, you want to buy more and you don't want to get carted out.
No, very good points. And I think that's why we're not seeing institutional adoption, because nobody can afford to take that kind of hit, right? You'd be out of a job pretty quick.
Oh yeah, like the hedge funds have what's called a Sharpe ratio, right? And that's the way you raise money in a professional asset manager. You raise the money based on your Sharpe ratio, and that's how volatile your fund is relative to performance. And Bitcoin, I don't see how you can run a Bitcoin or a crypto fund without an obscene Sharpe ratio, which, and like to your point, and that's why a lot of the real money hasn't come in.
So I didn't ask you about oil. It's been trading between a very tight range, 70 to 80 bucks a barrel this year. And in spite of everything that's happening in the Middle East, I'm surprised it's not significantly higher, but maybe that has to do with a weakening economy. I don't know. What are your thoughts on oil? Where do you see it going in this inflationary environment?
Well, that's where, when we talk to professional investors in our chat, a couple of points they make is that, so Buffett owns 250 million shares of Occidental Petroleum, 250 million, 260, something like that. The last 100 million shares, he bought Occidental equity above where it is today. So what we're noticing is that some of these equities are trading near their 200-week, Jim, 200-week moving average. I can't emphasize that enough. If you can buy when I sat down with Charlie Munger in the book in Omaha, he says, listen, he said, Larry, we're not technical and analysts, but he says, listen, when an attractive stock that we like gets near the 200-week moving average, 200-week moving average, that gets our attention. And in the book, we sat down with David Tepper, David Einhorn, Charlie Munger, and these are some of the secrets. Yeah, so when we look at oil, it's an election year. If you look back historically, oil in election years, especially in the third quarter, the returns are just not good because any administration does whatever they can. The Biden team has unloaded the SPR. China has been slowing down all year, and now this stimulus is coming on. So I think you're going to have a big rally in oil the next couple of years. And so, yeah, this is a good spot to kind of get into stocks like Occidental Petroleum that are trading near the 200-week moving average, Schlumberger near the 200-week moving average. And you can buy Oxy, like I said, cheaper than where Buffett bought it in the last year. Don't forget, not all his position. I don't want to get corrected, but out of the 260 million shares, the first 150 million he bought a lot cheaper than where it is today. But Buffett's, if you look at Buffett this year, what's he doing? What is Buffett doing? He's selling Apple. He's buying Occidental Petroleum. That tells you right there, you want to be getting out of tech stocks into global value stocks and stocks that are exposed to commodities.
Is that the only oil name he's buying?
He has some Chevron. Yeah, it's Chevron's, a larger cap company. It's a safer company. And we haven't, I don't think we've seen him go toward the servicers yet. The Schlumberger would be the one he would buy. I mean, Schlumberger is the Microsoft of the servicer companies. But one of the investors in the chat said, I just want to frame this right. He said in 2014, they made $2 a share. I think it said $2 a share, Schlumberger. And he said this year, even with oil somewhere in this area, they're going to make $2 a share. So his point is that if oil is actually a little bit, if oil's 10, 20, 30% higher, Schlumberger's earnings are going to be, potentially $3 or $4 a share. And so you got a lot of upside with some of these, energy names, especially in the service sector.
So a number of people have submitted questions when they found out you were going to be speaking on my show. And I want to read you one of the questions. And here it goes. If the economy slows down and we get lower earnings and lower profit margins, and central banks also cut rates to help pay off their debts, do you recommend investors buy gold producers or invest in physical ETFs?
Yeah, in that world, so if you have an economy that's slowing with some real volatility, the gold producers are going to be there. Like I said, they're higher beta. They're going to be more volatile. But then the Fed gets, in that kind of world, the Fed gets cut. Fed goes into a real cutting cycle. Low interest rates come down, and that's where the gold miners are going to really outperform. So yeah, I'd much rather be long the gold miners when in an economy that's weakening, where the Fed has to cut rates. That's where the gold miners are going to outperform them. The gold miners typically outperform in rate cutting cycles and underperform in hiking cycles. And so, yeah, but I want to be careful. It's similar with Bitcoin. You want to be prepared to buy the gold miners on volatile days because they're just so much more volatile than gold.
Larry, I want to ask you about your new book now, How to Listen When Markets Speak. You've been on the road marketing extensively here in the last couple of weeks. You were recently in Geneva and Zurich and also in New York. And I'm curious to hear what you're hearing from these investors that you're meeting with. Do they have any concerns about the current economy? Do they have any concerns about the global economy or markets?
Well, one of the large families was there, and with his chief investment officer, and he controls a company, a group of companies that are in the retail space, and he just thinks that there's definitely a real contraction in the middle class consumer spending, and he says it's getting worse and worse and worse nearly every month. And we're now in the pre-holiday season, back to school, and he said this is not about his company. He sees it across the whole sector. He goes to the conferences and he's got access to the real-time data. So yeah, the Fed's cutting rates for a reason, because the economy is slowing. This is almost like the point that they make is like the point that some of the best investors that we talk to are making. This is like a 1980s supernova recession. Like there's two types of recessions historically. In the one from the 80s recession is when you have a hot economy that grows so hot, inflation gets really high, and it starts to crush the middle class consumer, crush growth. And you're seeing that with Ally Financial now. They just reported within the last month, on auto loans, defaults. And so we're seeing this, real consumer pain, but it's going from, it was in the lower to lower middle class, then the middle class, and now it's moving into the upper middle class. So it's affecting a larger and larger and larger and larger part of U.S. GDP. That's one of the big takeaways from the meeting. And then is, if Kamala Harris doesn't have the Senate or doesn't have the House, let's just say it's a tight election, but she wins the presidency. And this could happen because a lot of Rhino voters, there's some voters that don't like Trump, but they're Republican and they'll vote for Kamala, right? But they'll also vote probably Republican on the other side of the ticket. So if she doesn't have, if she wins without the House or the Senate, if it's that kind of split, you could have a nasty fiscal cliff next year where, remember, we were supposed to do 1.6 trillion of spending. We're 2 trillion. So they tried to juice it into the election, right? Now the Republicans, the debt ceiling comes due here in early January. They have extraordinary measures. They have the extraordinary measures. That'll get the debt ceiling out to, say, March 10th. So that's one of the things we're seeing investors focus on is, this is a trade that, this could be very interesting because that could create real stagflation. Because what'll happen is, if it's a debt ceiling, if you go from 2 trillion of spending to say 1.4, the economy will continue to slow, but at the same time, probably won't slow fast enough to kill inflation because you're going to have this bounce in inflation from all the China stimulus and these port strikes and protectionism. And so, yeah, you could have a real kind of stagflationary type debt ceiling crisis in that first quarter. And then the other thing we talked about is just the other thing they're talking about in the chat is the amount of bonds that have to be sold. So one of the evil things that and I don't mean, I think like this is like Dr. Evil. Janet Yellen is a very smart financier, right? She's Treasury Secretary of the United States. But let me give you an example. So 2024, 25, and a little of 26, the close to 15 trillion of the U.S. debt comes due. And so what she did was smart. If she wanted to keep down volatility, she issued so many T-bills. So a T-bill matures within a year. And so when you have a T-bill and interest rates go up, it doesn't really move in price. But if she had issued 3 or 4 or 5 trillion of longer dated bonds over the last year and a half, those bonds would have been moving like this, because the 10-year bond moves more very violently relative to a T-bill, right? So you got bond. So what she did was she issued almost everything, like $2 trillion, $2 to $3 trillion of T-bills, and they mature in 1 year. Now all those are going to mature over the next year, and then so we're going to have a big funding crisis next year where then at some point the next presidents have to farm out this debt. They're going to basically have to issue a lot more longer dated bonds than Yellen issued this year into the election. She didn't want to issue that many longer dated bonds into the election because she didn't want bond volatility in the election. She's a clever little cat, isn't she? And so this is a really clever move, but it puts the country at risk, right? It's the type of thing, and the people in Washington will never admit it, but she's going to have to, the next Treasury Secretary, whether it be Yellen or Mnuchin, somebody like that, they're going to have to farm this debt out over 5, 10, 20 years. And it's going to be, then the curve's going to really steepen because you're going to have a lot more bond sales, higher interest rates on the long end. The Fed's going to have to come in and start buying that longer dated paper to keep those yields down. And so, yeah, that's what the smart money's saying around the world.
It's amazing, regardless of the party, what these politicians continually do is just kick the can further down the road and just hope somebody else can look after it, right?
Yeah, and that's one of the downfalls about a republic is because you have these 4-year terms, and then in the case of Biden, he's now not running, so Kamala can come in, but it's just people just don't think long term enough. They really want to pass it on to the next administration or the next, just get reelected and get it and then deal with it. They just want to, they'll do anything to keep Trump out of office, right? Forget about whether you like Trump. The bottom line, they impeached him twice. They have 6 court cases against him. They took fiscal spending up $2 trillion, up an extra 400 billion into the election. They will do anything to keep him out of office, but there's a price to pay for that. It's not free. As investors, forget about whether you like Trump or not, right? This is not free, what they've done, right? They've done it to keep him out of office. That's fine. That's their game, right? That's fine. But there's a price to pay for it. It's not free. It's not like it's not like lollipops and popcorn. I mean, this is a very serious thing that they've done. And so we will pay the price for it next year and the next, probably 2025, 26.
So it sounds like 2025 is going to be one hell of a year. So
yeah, and that's the other really wacky thing is like all the investors, the institutional investors we talk to say, 24 is going to be okay. They all say the same thing. 24 is going to be okay, but I just don't know how we deal with this in 25. And so I find it interesting that like everybody thinks we're going to get through this year fine. Everybody like that. And so we probably have a little bit more volatility toward year end because most people think that it's so certain that we get at least through the election without some volatility.
So how are you recommending to investors, how should they position themselves as they go into 2025? Go all
well,
cash?
the old 60-40 portfolio is dead. That's the one of the points we make in the book. And I'm proud. We wrote this 2 years ago, and a lot of the things that are coming true. And I owe this to all of our advisors in the chat, their Bloomberg chat, our institutional investors. But yeah, so the 60-40 portfolio is dead. So right now you want to be 35% stocks, 35% bonds, and then 30% cash. So 35, 35, 30. And that cash allows you to take advantage of volatility. So as you get some volatility in the market, you want to, buy more stocks and buy more, take advantage. You want to take that, but so you go 35, 35, 30 now, right? But as you get some more volatility next year and some real opportunities, you want to take that stock, that cash from 30% back, back up to 40 or 50. But within the stock bucket, you want to have more value stocks, more global value, more hard asset type companies than the previous decade portfolio was, FANG stocks and growth. The next decade portfolio is going to be much more of a hard asset portfolio of value stocks.
So your gold component would be under equities?
Yeah. At this point, I'm like, yeah, I'm calling that. Well, I would also say so. Yeah, your gold, your commodity component can be part of the equities, but I think that you can also own. You can also own some commodities outside of the bucket. So maybe you can, because the way I'm thinking about it is more from an aggressive point of view, right? I want to own my commodities in that stock bucket, but if someone's a little bit more conservative, then they want to own raw commodities, right? Because the commodities are a little bit more conservative than owning the equities, right? So then you'd have to reframe. That's where you need to talk to your financial advisor.
Well, it sounds like the next few months are going to be quite interesting, and I want to thank you very much for sharing your thoughts with us today, Larry. If somebody would like to check out your book, How to Listen When Markets Speak, where can they go?
Well, they can go to on Twitter. I'm at ConvertBond. They can find us there. They can find us on Amazon, and then we're in most of the bookstores. I saw the book in a lot of the airports, and just ask a friend about it. Please, maybe give a post on LinkedIn if you like the book, or a post on Instagram or whatever. Take a picture of the book cover, and I really appreciate it.
Well, listen, that was a great discussion, and I want to thank you very much for spending time with us today, and I look forward to speaking to you again sometime in 2025.
Thanks, James. All the best.